Good afternoon, everyone. Thanks for joining us for Understanding Your Retirement DNA. I have just a few announcements for those of you who are requesting credit. Please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we'd like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we'll follow up with you afterwards. Tomorrow, you'll receive an email with a link to replay today's broadcast. Let's get started. Today, we're joined by Kate Blake, Learning and Development Manager at Pentegra. Kate has been with us since the beginning of her career, where she started in the retirement benefits field. Being the quick learner and talented contributor she is, quickly arose into various positions within Pentegra. Kate's been able to exemplify her deep roots of industry expertise in each position she's held, and her skills have always been the perfect complement to Pentegra. Kate, I'll turn this over to you to start talking about retirement DNA.
Great. Thanks so much, Noelle, and thank you everybody for taking the time to tune in and join us today to talk about what I think is kind of an interesting and a nuanced topic. So when we're talking about retirement plan DNA, we're talking about what makes a retirement plan unique. And there are certain features that offer so much possibility when it comes to diversity of options and plan provision. And these key provisions that I would like to discuss today, I think are useful ones to keep in mind when we're meeting with our clients, because they really can have an impact on the participant experience and their retirement readiness. So some things that we're going to talk about today include key considerations of a rollover, understanding a plan's unique options pertaining to things like, for example, in-service and other distributions to access plan assets while working, understanding the special tax rules for NUA in employer securities, and non-Roth after-tax accounts and DB lump sums. This is about 6 different topics here today. We've got about an hour, so I think we'll probably spend around 10 minutes per topic or so. And if we go over on any of the topics, that's okay. Everything that we're going to talk about on items 1 through 5 here is applicable to 401ks, 403bs, and in some cases, DB plans. This last item is the only thing here that's DB plan specific, and as many folks on this call probably already know, DB plans are less prevalent today. So really want to focus in on these first 5 items, which reflect potential provisions in plans that, most Americans might see in their retirement plan. So back to this, what is retirement DNA question? We all have distinct physical DNA, and while we can't change what we were endowed with by nature, we can make the most of it through our actions and behaviors. We can eat well, eat our broccoli, make sure we exercise and get a full 8 hours sleep every night in order to maximize our physical DNA. This idea of retirement DNA is similar. Like our physical DNA, each of us as individuals has distinct retirement DNA. And what does that mean? Throughout our adult lives and throughout the lives of our clients and participants in our retirement plans, we move from employer to employer throughout our working careers. During that time, we're moving through different types of retirement plans and accumulating different types of benefits, all with different provisions. Your physical DNA may say blue eyes, blonde hair, but your retirement DNA might say, well, maybe you've got a 401k plan from here, a non-qualified deferred comp plan from there, and maybe a Roth IRA from back in the day before you ever enrolled in the 401k plan. And I think as we meet with retirement plan participants in the plans that we work with, we find this very often, that very often people have a smattering of benefits from different plans that all have different rules. And that is one reason why it's so important to understand this retirement DNA or blueprint for each plan. Because when we understand the rules for each plan, we can understand how to maximize that retirement DNA. That brings us to our first polling question. Which of the following statements is or are true? A, like physical DNA, everyone has retirement DNA. B, as workers change jobs, they may accumulate a variety of workplace retirement plans. D, there are ways to maximize a person's retirement DNA. C, there are ways to maximize a person's retirement DNA. Or D, all of the above.
The polling question should now appear on your screen. This poll will be available for another few seconds for anyone who's yet to select an answer. Poll is now closed. Kate, you may continue.
Thanks, Noelle. And of course, as we said, the answer is all of the above. We've all got retirement DNA, just like our physical DNA. We accumulate a number of plans, and there's ways to maximize the benefits that the clients and participants in these plans accrue. So now let's turn our attention to these 6 different areas that we can focus in on and maximize the retirement plan provisions. We'll start by taking a look at rollovers. Let's take a look to begin with just at some basic rules. The taxable portion of a withdrawal from a qualified plan or IRA is subject typically to ordinary income tax and may be subject, with a few exceptions, some of which we'll speak about today, and may be subject to a 10% federal early distribution penalty if taken earlier than age 59 and a half. Taxes and penalties, though, don't apply if the qualified plan withdrawal is directly rolled over to another qualified plan or IRA. Qualified plans generally must withhold 20% of the assets unless the distribution goes directly to another qualified plan or to an IRA. With this and so many of the other topics that we're going to discuss today, investors, and by that I really mean the plan participants that we may encounter on our work, should take into account any potential tax consequences, as well as expenses, sales charges, and or penalties for selling or buying investments before initiating a rollover. There's a lot of different types of plans that may permit rollovers. Like I said, these first provisions really are wide-reaching. Typically, you'll see rollover provisions in your 401k style, 403b style, governmental 403b plans, and profit-sharing plans. Some defined benefit plans will allow you to take a lump sum of your benefit, which in many cases then you can roll over to another plan, like a 401k or an IRA. Cash balance plans are kind of non-traditional DB plans where the default method of expressing the benefit is already in the form of a lump sum. So cash balance plans permit lump sums as well and rollovers. And then IRA-based plans. A few caveats with simple IRAs. Assets can be rolled over if the account is held for at least 2 years. And there is a Secure 2.0 change effective in 2024 following a simple IRA plan termination. The 2-year rollover wait is waived to a replacement plan. And also SEP IRAs, the Simplified Employee Pension, may permit rollovers as well. So it's an important topic to consider and to understand the specific provisions that are in place for each plan that a participant may have accrued a benefit in, because depending on what type of plan it is, the rules may be different. Something I see pretty frequently is somebody who may have a 401k plan that obviously does allow for rollovers, And they may also have a traditional DB plan that doesn't allow for lump sums, which by default does not then allow for rollovers. I see a lot of plan participants calling record keepers, especially for those DB plans, and asking for lump sums where they're not available, and then getting frustrated. This is a place where we can add value, making sure that employers and in turn participants understand the provisions, make sure that these plans are administered properly. Generally, this brings us to our second poll question. Distributions of pre-tax dollars from a 401k plan are A, exempt from federal income tax and penalties, B, subject to federal income tax and may be subject to an early distribution penalty, C, exempt from federal income tax and penalties if directly rolled over, or D, both B and C.
The polling question should now appear on your screen. This poll will be available for another few seconds for anyone who's yet to select an answer. Poll is now closed. Kate, you may continue.
Thank you, Noelle. And it is answer D, both B and C. They're subject to federal income tax and might be subject to the 10% early distribution penalty for distributions under age 59.5, with some exceptions to that rule. And they're exempt from federal income tax and penalties if directly rolled over. So let's talk about understanding a plan's unique rollover options. So a rollover starts with a plan distribution, and this is where we can kind of take it to the next level. First, it's understanding the basic provisions. Then it's understanding how they work together, exceptions, special rules, and again, communicating that information to the employers that we work with and in turn participants. This is great fodder for if you ever do employee education meetings. When I used to do those meetings, like I said earlier, I used to meet with so many employees who had multiple different benefits, and that was sometimes their biggest stumbling block to getting things in good order. It was just like, I've got so many plans, I don't know what to do. Showing people a chart like this can help them put their benefit accruals in that greater context of a holistic picture of retirement readiness. So let's look at this in a little bit more detail. So we're looking at DC plans, that's going to be your 401ks, your 403bs, things like that. DB plans, mostly we're talking about our traditional style pension plans here. And then IRA-based plans. Let's actually start over here on the right, the IRA-based plans. These are distributable. This is the rule of thumb for when we can take money out of the plan. These are distributable on demand of the IRA owner. Now, just keep in mind the taxes and penalties may apply under certain circumstances, but typically a participant or an individual who has an IRA could request a distribution of those assets at any time. Then we have DB plans. This is kind of why I wanted to start over here, because these are really on the total opposite side of the spectrum, where your IRA-based plans are very flexible in terms of distribution provisions. The defined benefit plans, in my opinion and experience, tend to be some of the less flexible plans when it comes to distributions. Typically, your DB plans, always, they'll offer annuity payments. Those annuity payments are not eligible for rollover. It is only if the DB plan chooses to offer a lump sum that you'll see it in the plan. And that tends to confuse a lot of plan participants that I meet with as well, because a lot of people are familiar with these IRA-based rules. I can have my money anytime, and don't realize that the DB plan is a little bit less flexible. Not to say it's bad. I think that the next step of this is helping participants understand that each of these components of someone's retirement DNA can serve a purpose. For example, that DB plan may be less flexible, but it may be a baseline level of retirement income that you can never outlive. The IRA-based plan or a DC style plan may then help to fill in the gaps. The DC style plans, the rule of thumb we already said, not prior to age 59 and a half for employee deferrals. Unless there's a hardship, hardships can be taken at any time, provided that immediate and heavy financial need is met. But there is still a 10% early withdrawal penalty for those hardship withdrawals. The nuanced thing about all of this is that for every rule in the retirement plan space, there's almost always an exception to that rule. So with a DC style plan, we said typically you can't take a distribution prior to age 59 and a half. Some exceptions include after-tax money, which we'll speak about in just a moment. Typically that has much more flexible distribution provisions. Depending on the employer election in the plan document or adoption agreement, sometimes employer contributions may be available, and money that has been rolled in from another source is typically also available for withdrawal in a DC style plan with less rules around it. We already mentioned for the DB plan, the exception here is while they are by default annuity based, some of them offer lump sums, but that is at the discretion of the employer or plan. And then there is also an exception for the IRA-based plans as well. Simple IRA assets, we mentioned this already, may not be rolled over within the first 2 years of participation. So be aware of the rules, but also be aware of the exceptions. And then what sort of opportunities are available within those exceptions. And by that, I mean things like in-service distributions, after-tax contributions, and then distributions of that money and things of that nature that we're going to talk about next. But the bottom line is read the fine print, because we get participants calling us all the time saying, I'm ready for my money. And, you know, in many cases, they have not met the rules regarding distribution of those assets and can't take a distribution. That causes a negative client experience. So it's always better to make sure that participants are familiar with those rules up front. And ultimately, at the end of the day, it really starts with making sure the client is familiar with the rules. That way, HR or whoever is in charge of the plan can disseminate accurate information to those participants. If there's one other thing I've seen about retirement plans, it so often becomes a game of telephone where somebody says something to one person and then that gets repeated to somebody else, and so on and so forth. Ensuring our information is correct and accurate from the get-go can help reduce confusion and those negative client experiences. But also, like we said before, when we understand these basic rules regarding rollovers and basic distribution rules, we can then kind of start to dive into the nuances and look at the opportunity that we have within the plan document. So those rules that we talked about are just the basics. A plan or employer could elect to offer in-service distributions, which allows participants to access plan assets while they're working. There's a little bit of a philosophical component to this and some of the other topics that we're going to discuss today. It's not necessarily always just offering everything that's possibly available. You know, you might not necessarily as an employer or as an advisor want to recommend to an employer that they tick every single box on an adoption agreement just because it's there. We want to make sure that we're matching up the right plan provisions with the demographics of the employer or client that we're working with. So in-service distributions, in my opinion, offer a great amount of flexibility in retirement plans, but they also are a double-edged sword. It makes participants happy. People like the optics of being able to access their money when they need it. However, I see far too many people who believe in their hearts that their retirement plan is a piggy bank for themselves. And I see people take as many in-service distributions as they are allowed every single year for whatever they've got going on for that year. So weigh these provisions carefully when you're making recommendations to a client. Look at the history of the plan. That's something that I love to do. I love to pull the last 5 years of participant data from a plan and look at the trends in-service distributions over time, because that gives great insights into what people are doing. So with that philosophy aside, in-service distribution triggers really depend on the plan type and employer design elections. So once you have determined that you have a client who might want to offer some in-service distribution provisions, then the next step is to craft the provisions in a way that is optimal for them. First, let's establish the type of plans that are eligible to offer in-service distributions. It's the usual suspects here: 401k plans, profit-sharing plans, 403b plans. It says DB plans on here, and that is correct from a regulatory perspective, but in my practical experience, I don't see them offering in-service distributions that often, but I've seen it out there rarely, but it is possible. Then we have a number of different ways that you can slice and dice eligibility for in-service withdrawals. It can be age-based, it can be source-based, it can be service-based, it can be reason-based. So let's talk about these. And let's start at the bottom of our list here, because I think from what I've seen, most plans offer hardship withdrawals. I think too, if we're thinking about this from a philosophical perspective, which is what we need to do when we're talking about retirement plans, because we're dealing with humans and their money, which is a very emotional topic, I think most employers tend to want to offer hardship withdrawals because it looks good to participants. It provides them their money in a time of need. And that can be a positive thing for an employer who is more paternalistic and wants to make sure that their employees are taken care of should they need to access money for some reason. Then we have some other reasons. We have source-based. I'm going to jump around on this list a little bit because I want to talk about them kind of in order of popularity that I typically tend to see them in plan documents. So almost every document I see has hardship parameters. I see most documents will allow you, as we said earlier, to access a rollover account at any time. And I've seen many documents that allow employees to access employer contributions. Then we could employ age-based parameters. Pretty much every plan document out there allows you to take your money out at age 59 and a half. And service-based. This is my experience talking, but I see this one maybe a little bit less frequently, but I do definitely still see it out there in the field. This is like a 2-year bake rule in here before you can access certain sources in a retirement plan. This is a little bit more of a liberal parameter in my view. You know, again, the hardship, that's kind of a need-based thing. The rollover, that was your money from before. The age-based kind of ties into the regulation. But the service-based ones, like the 2-year rule, again, that's a little bit more of a perspective like, I'm the type of employer who, if it's my employee's money and it's in their account, I want them to have access to it. The flip side of that coin might be the type of employer who says, no, I really want to make sure that my employees are not using this as a piggy bank and that they are prepared or as prepared as they can be for retirement. And I want to do everything I can to contribute to that. That type of employer might not want to have service-based in-service withdrawal parameters. And this is where you can see the value in understanding the nuance of the rules. Because what you can do here the next time you meet with your clients and do an annual plan review is tee up the discussion. Say, hey, do you know what your rollover and distribution parameters are? Go through it in the adoption agreement. And then you can have this philosophical discussion about, well, hey, are those provisions that you've elected right for you? Let's talk about your demographic needs. Let's talk about your feelings around retirement readiness, and then let's target those provisions to match those needs and the demographics of your employees. That's a great way to add value to a relationship and make a client stay a client for a long time because they feel you know them as a client and that you care about them. And I think that we all tend to get so consumed with the day-to-day work of keeping a retirement plan going that a lot of times these kinds of discussions do kind of fall by the wayside in favor of other time-sensitive things. So setting aside the time to have these discussions and not only going through the basics, but also the philosophy of it really can set you apart as a service provider in the industry. Let's talk about something else that is sort of tangentially related here. On some of the previous slides, I said that there are some exceptions to these distribution rules in terms of certain sources where you can typically take your money out on a more flexible basis. And I gave the example of rollover in money being one of those sources, again, because it was your money from before. After-tax money also often comes with liberal distribution rules. Typically, after-tax contributions can be withdrawn at any time. And there's some nuance around the taxation. You do not have to pay taxes on any of the after-tax contributions that you've already put into the plan, but earnings are taxable. And that's the difference between Roth and after-tax. Well, I should say one of the differences. We'll talk about a few more in just a minute. But again, so the Roth, most people when we're talking about after-tax assume Roth. It's the more well-known one. I think it's probably the more popular one. And arguably, it comes with more tax benefits, right? Because with Roth contributions, I think we all know, you put the money into the plan on an after-tax basis, and then as long as you meet certain requirements, age 59 and a half, and have held the account for at least 5 years, then your distributions are tax-free, which is a tremendous benefit that allows you to take advantage of a potential working lifetime of growth and compounding. After-tax is not that. It still goes into the plan on an after-tax basis, but like we said, the earnings are taxable later. So let's talk about some stats around after-tax and who might be interested in using this contribution type and what plans might benefit from permitting it. Not a ton of plans offer after-tax. It is kind of like the granddaddy of retirement plan contributions. So, for example, here at Pentegra, we had a very old MEDC plan that we founded actually pre-ERISA, our MEDC plan, which is our multiple employer plan for financial institutions. Because that plan was pre-ERISA, those contributions that went into that plan way back in the early 1970s, those were after-tax contributions. So there was a time way back when after-tax was used pretty frequently. But then with the advent of ERISA, pre-tax contributions, which have more tax benefits than Roth contributions, I think after-tax kind of fell out of favor a little bit. But I think it's kind of coming back into favor over time, and I'll show you why next. But yeah, so only 25% of 401k plans currently offer after-tax contribution accounts. So this is an area for opportunity when you're doing those annual plan reviews, again, just as a place to add value. And like we said, as you can see in the second bullet point here, these after-tax sources are pretty flexible. Many of them allow distributions of an after-tax account at any time for any reason. You don't have to have an age requirement or documented hardship or anything like that. And we already established this, but just to reiterate, these after-tax sources are separate from a Roth 401k source. So who might benefit from making or offering, if we're thinking about our client, our book of business, who might benefit from after-tax contributions? Well, from a participant standpoint, number one, your plan has to allow for it. If a plan does not allow for after-tax contributions, which as we've seen is 3/4 of the plans out there, it's not a showstopper. The plan could be amended, and then those contribution types could be allowed. But it has to be offered in the plan. And what it lets people do, in addition to just, again, giving a little bit more distribution flexibility, it really is beneficial for what I'll call the super savers of the world. It allows you to set aside more of your wages per year for retirement beyond the standard limit. And I think we all know 2025 limit is $23,500. Basic catch-up ages 50 to 59 is $31,000 or $34,750 if a plan offers the enhanced catch-up provided for via Secure 2.0. So just on their own, the basic limits are pretty substantial. Let's forget about catch-up just for the sake of conversation, just to make things easy. On a pre-tax and Roth basis, in 2025, a participant can put up to $23,500 in their, let's say, 401k plan. But after tax actually allows you to go above and beyond those limits. That's why I say it's useful for the super savers. So you can contribute up to the $23,500. Again, let's forget about catch-up just for the moment, on a pre-tax or Roth basis, and then you can keep going if you want to on an after-tax basis. And those two things, the distribution flexibility and the ability to supercharge your retirement account, are the reasons why a participant may consider using this source and why a client may consider offering this source. This is also, and we'll talk about this in just a minute, this is a tax-efficient and potentially tax-free way to acquire Roth IRA assets. Why? Because of those rollover provisions that we started with. Do you see now how all these provisions that we're talking about today are tied together? They all seem separate and disparate when I rattled them off at the beginning. Rollovers, distributions, in-service withdrawal stuff, after-tax contributions. But it's all tied together in terms of what types of distributions you offer, when, and that ties into what types of then sources you allow into your plan. So this is a really interesting feature. We'll come back to it in just a minute. First, let's talk about the supercharging your balance. So after-tax source ties in with the 415 limit, or some people call it the annual additions limit. It goes by many names. But that's the maximum amount that you can contribute for a calendar year. So again, let's forget catch-up just for ease here. I'm just going to go with the regular limit of $23,500 as established. That's what we can do on a pre-tax or Roth basis. But the annual additions limit is $70,000 this year. Again, forget about catch-up. What this means is that a participant can accrue balances up to $70,000 of contributions into a qualified 401k, 403b account for 2025. The catch, it's the sum total of all sources that come into the plan. So what do I mean by that? $23,500 can come in on a pre-tax or a Roth basis. Then I almost surely have some sort of employer contribution component in this plan. Maybe there's a profit sharing, a non-elective contribution, a match, whatever it may be. Tack that onto the total. We're adding up the sum total of all of these. Let's say the sum total of pre-tax, Roth, and employer contributions is $30,000. Let's say I do my 23.5 and I get the rest in some sort of match. That means I can put in, with an annual additions limit of $70K, $40,000 on an after-tax basis, which is hugely substantial. Again, it doesn't come with all of the benefits in certain circumstances as the Roth. If you just take it as a direct distribution, it is going to be subject, those earnings, I should say, are going to be subject to ordinary income tax. There is a little bit of a nuance, and this is rapidly becoming a niche nuance because it only applies to pre-1987 contributions. But if any participants out there do happen to have those balances on an after-tax basis in their account, this was a rule change. Pre-1987 contributions should be accounted for, maybe in a separate source or at least notated on a participant's account balance. And those contributions are going to be distributed first. And then post-1986 contributions and earnings are distributed second on a pro rata basis. That could potentially have tax implications for those who are taking a partial distribution. I should say a partial direct distribution. They're not rolling over those assets. Again, that's a niche situation, but here I am extolling all of the benefits of after tax. I should probably talk about the potential nuance as well. Okay, so I mentioned that typically with your after-tax contributions, your principal or the money that you have put in is tax-free, but your earnings are taxable. And that's if I just take it in a direct distribution paid to me, I'm just taking the money, putting it in my checking account and paying the tax on it. However, there are some opportunities in rollovers. And this was something that was clarified by IRS Notice 2014-54. What this allows us to do is split those post-1986 contributions and earnings and traditional, or split the contributions and earnings and put the earnings into a traditional IRA, thus deferring taxation because you are rolling the benefit. And then the contributions can go into a Roth IRA. This allows for a more favorable tax treatment of those contributions that otherwise, like I mentioned, would have just been taxed immediately upon distribution. With this solution, you can take those after-tax funds, get some of it into a Roth that represents your contributions, not have to pay taxes on that money, and then that money will grow tax-free until you take it out. And then the earnings, again, can go into a traditional IRA. Now, there is some nuance with this. So this is not beneficial for everybody, but if you have any participants in plans with substantial after-tax balances looking for tax strategies, this is an interesting one. This is a situation where if you had any participants exploring what to do with after-tax balances and rolling it to multiple accounts, I may recommend that they consult with a CPA because no or very few retirement plan firms are going to give any participants tax advice. And this gets into nuanced territory, but it's an interesting opportunity to consider because a lot of folks do have some, older after-tax balances out there that have a substantial amount of growth in the past decade, 2 decades. So where to go from here? to bring it back to the beginning, first, just make sure that any plans you work with, if participants are interested in this, have an after-tax account. I don't think this is for everybody. I think there's probably a reason why after-tax source is only in 25% of plans at this point, because most people don't max out their benefits to begin with. But if you happen to work with a client and you notice that they have employee demographics where the employees are maxing out their benefits and they don't have after-tax, this is definitely something to consider. And it says on here, I think everybody is probably already aware, but participants should be able to easily access the summary plan description or SPD, and that should indicate all of the sources that are available. All right, it's time for our third polling question. Complete the sentence with respect to standard after-tax contributions in 401k plans. A, check the plan document to determine whether a 401k allows for after-tax. B, after-tax accounts can facilitate tax-efficient Roth conversions. C, the IRS requires all plans must allow for after-tax. Or D, both A and B.
The polling question should now appear on your screen. This poll will be available for another few seconds for anyone who's yet to select an answer. Poll is now closed. Kate, you may continue.
Awesome. So the answer, of course, A and B. After-tax is definitely not required in every plan and not suitable for every plan either. That's where we think, again, to our philosophy of retirement plan administration. This is good for those types of demographics where you've got a robust population of HCEs or others who happen to be maxing out their accounts, who may be looking for more, or who are interested in advanced tax strategies. Speaking of tax strategies, that one, as we said, good for HCEs. Here's another tax strategy that is useful for folks who may find themselves with balances in employer securities in qualified retirement plans. Net unrealized appreciation, or the NUA rules. This applies to plan participants who own qualifying employer stock within a 401k or other eligible qualified profit sharing plan or something of that nature. Now, this is another situation where you can really target certain benefits and maximize people's retirement plan experience if you have your documents set up right. So it's got to be a plan that has employer securities, and it has to be a plan that offers a lump sum distribution that includes in-kind shares of stock. Where do I see people getting tripped up here? I see a lot of plans that have employer securities that require you to take a cash distribution. The rules are not going to apply there because you have to be able to take the stock in kind for these special rules to apply. That will make sense in just a minute. In kind, just to level set, in stock instead of in cash. The payment of your qualified plan participant's account balance has to be made within a taxable year, either due to death, attainment of age 59 and a half, separation of service, or disability. So translated into English, this is something that's used a lot by employees with stock balances and 401k plans that offer a lump sum payable in stock, basically. How does it work? So let's look at an example. We've got participant Ellie. She invests a piece of her 401k plan assets in the common stock of her employer, Big Time Company. Upon termination, she takes a lump sum distribution, which includes $350,000 of the stock. The cost basis, or what it costs to acquire these shares of the BTC stock in the plan, is $75,000. But the stock has appreciated over the years. It's currently worth $350,000. So If she took everything as a cash, before we get into the special rules, if she took everything as a cash distribution, it would be taxed as ordinary income. That's why the plan needs to offer that in-kind provision, again, taking it in stock. So she takes a lump sum, she takes it in kind, in stock, she rolls the stock to a brokerage, right? So now she's got stock outside the 401k plan on her own at this brokerage. Here's what the benefit is. Instead of everything being taxed at ordinary income rates at the time of the distribution, really two benefits. Number one, the taxation is spread out, which allows for, smoothing of your tax experience. But also, it could potentially be more favorable taxation parameters depending on your income and tax situation as a participant. So this too, if you have plans that offer this, and if you encounter any participants who are interested, is where I would refer somebody to a CPA or someone along those lines. But let's talk about how this works. So with these rules in place, she takes her distribution in stock, and at the time that she takes her distribution and puts it into the brokerage, the cost basis, which is the $75,000 we're over here on the right now, is taxed as ordinary income, just like your salary. But all these earnings, the $275,000 in earnings, is not taxed at the time of the distribution. The benefit, again, smoothing out your taxation, but also, if you expect that this stock is going to continue to appreciate, the full value of this $275K is now growing and working for you, which can be a tremendous benefit depending on the situation. Then, let's say she sells this 2 years later. It has to be at least 12 months for these specific favorable set of rules to apply. But if you sell this, then later, the stock, over 12 months later, at the time of the sale, you've already paid taxes on the initial 75. The 275 of this original growth is taxed at the long-term capital gains rate, as is, assuming you wait a year, your additional earnings. So let's say this is the amount she took, the 75 in cost basis, the 275 in earnings. She put it into her brokerage, and then it grew by another $50K, and then she sold the position. She would be taxed at the long-term capital gains rate on these two blue pieces. And the other benefit of that, like we said, is this really depends more on your tax situation, but this could be a potentially more favorable tax rate. Long-term capital gains, typically, depending on your situation, are more favorable. So for somebody in 2025 who's married filing jointly, the long-term capital gains rate is 0 up to $96,000, 15% between $96,001 and $600,050, and 20% above that. So for some folks, this long-term capital gains rate might be less than their regular ordinary, or their regular effective tax rate, I should say, creating a more favorable tax picture at the time of sale. So two main benefits to this, but it has to have that specific set of parameters where the stock is in the plan, can be held outside of the plan. Lump sums are allowed on an in-kind basis. But often, this too can be beneficial for HCEs who may tend to find themselves in a higher tax bracket. This is something to potentially consider. Employers who have employer securities in their retirement plans should check to see if they have these provisions ticked off, and by provisions ticked off, I mean, do you allow lump sums on an in-kind basis that would provide for this scenario? And if so, participants can request an analysis where they can take a look at their cost basis and market value, and that can typically be provided by the record keeper. And that's really helpful to us as retirement plan professionals, because then we can look at those documents with participants and help advise them as to the potential right solution. Okay, so we've got a couple minutes left. Let's spend that time talking about some DB lump sum payouts. So this is a little bit of a different topic because, again, this is specifically to our pension plans. And like I said, these are covering less folks. So really being familiar with those rollover, distribution, in-service, after-tax, and NUA provisions, those are the primary things to focus on. But there's a lot of value in understanding DB plans, specifically because they are not as popular. There's not as many retirement plan professionals in the space out there who are familiar with how these benefits work. So with the last 10 minutes, let's do a quick crash course. Only 7% of private U.S. companies offer DB plans. I think it's probably referring to traditional DB plans these days. And that covers 15% of U.S. workers. So this is not counting the public plans for teachers and police officers and stuff like that. This is corporate America. Now, it is worth noting in the third bullet point in the first section here that traditional DB plans are declining. They can be expensive, costs can be unpredictable, among other reasons. But cash balance plans, which are a hybrid type of DB plan, are kind of on the rise, especially in the current interest rate environment, which is a little bit more favorable than the previous lower rate environment that we were in for many years. Allowing lump sums in DB plans provides a lot of flexibility, not just to the participants, for all the same reasons we talked about for the 401k plans, but also for clients as well. If a client is soft or hard frozen and thinking about termination as something in the future, you need to have a lump sum in place in order to do that. So this is looking ahead to make sure that the plan is ready to terminate. It also can help you with de-risking a DB plan because it could potentially allow a client to add a lump sum window in the future where you can target and potentially offer favorable lump sum and distribution conditions to a specific group of employees. That's a great way to minimize costs in DB plans. But clients can't do any of this if they don't offer that lump sum provision to start with. That said, I think lump sum provisions have pros, which is what we just talked about, and cons as well. They can add a little bit of cost unpredictability, and they do have certain plan funding requirements around them. But it does make these DB benefits more portable because individuals who've changed jobs and left behind benefits can move them. They can take a lump sum and potentially roll it. And that's a big criticism of these traditional DB style plans. Typically, you're going to see annuities or lump sum options in a DB plan. With the annuity, the risk is borne by the insurance carrier. It provides a guaranteed lifetime payment and fixed income essentially forever. But inflation can erode purchasing power. You don't have access to the principal. You can't get any more money out of the plan, and limited ability to transfer wealth to beneficiaries. The lump sum, by contrast, gives investment control to participants. This could be a good thing or a bad thing, depending on how you look at it. But it could provide for growth potential and allow for additional withdrawals based on need and beneficiary strategies. But there's the potential for investment losses and outliving assets. So again, here too, there's some behavioral finance at play in both making the decision at the employer level to add the provision to the plan, and then also on the participant side of things, advising them on distribution strategy and whether it is more beneficial to take an annuity or lump sum. And that too ties back into what we were initially saying about rollovers and distributions. Got to know the rules because it's going to be different in every plan, and you don't have to take all of your distributions at the same time. There's a lot of strategy in staggering distribution timing, especially when a DB plan's in play. but can't do it without knowing the rules. So this is something for clients to consider if they are considering potentially adding a lump sum distribution. Think about those pros and cons and funding requirements. And then I say we, meaning all of us, can guide clients if they would like to add those provisions to their DB plans. Similar to making 401k or 403b changes, it's just usually ticking an additional box in an adoption agreement and creating and distributing an amendment. And I think I got a little bit ahead of myself here. That's primarily what this slide is talking about. If people don't know what a lump sum is, then we can review the plan document to help them understand what they have, what's potentially out there. And we can also help participants understand the difference between annuitization and a lump sum. A lot of times I find that participants get calculations that have lump sums on them and get stars in their eyes and think, oh, wow, that's a lot of money. I want to take that. Which is why you see in tips here, it says many times the distribution form only mentions an annuity option. There may still be an opportunity for lump sum distributions, and participants can typically ask for that, but our role as a guide sometimes is to temper those expectations a little bit and focus on those lifetime income or distribution and asset maintenance strategies. And that brings us to our final poll question of the day, which of the following statements is true regarding a DB plan? A, all DB plans must offer an annuity as a form of benefit payment. B, all DB plans must offer a lump sum as a form of benefit payment. C, a defined benefit plan annuity payment is eligible for rollover. Or D, A, and B.
The polling question should now appear on your screen. This poll will be available for another few seconds for anyone who's yet to select an answer. Poll is now closed. Kate, you may continue.
Thanks. I almost feel like this one was a little more tricky than the other ones. It'd say, all defined benefit plans must offer an annuity as a form of payment. Definitely don't have to offer a lump sum, and annuity payments are never eligible for rollover. Those have to go into a checking or savings account for those participants. All right. Well, we got a couple minutes left. Let's take a look at a summary and next steps. So when we're meeting with plan sponsors and clients and participants as well, let's help them consider their in-service distribution options, understand those NUA rules, review after-tax parameters in the plans, and if there are any DB plans in play, understand those pension payout options. So with that said, Noelle, I'll turn it back to you. Did any questions come into the chat box?
We do have a couple questions. The first one is, do many people take advantage of the NUA rules?
Oh, yeah, that's a good question. And, you know, I'm going to be perfectly honest. I think the answer is probably no. I think of all of the provisions that we discussed today, that's probably the one where it's a case of matching up the right person to the right scenario. And the specific reason for that is because not all plans offer employer security. But what I would say for anybody who's proactively thinking, make a list or, you know, look into any of plans that you do work with that do offer employer securities and see if they have those boxes ticked for the in-kind distributions, because that's really what's going to indicate whether or not participants can take advantage of these provisions.
Great, thank you. I think we have time for just one more. We have, are there any downsides to an employer offering after-tax contributions?
Oh, yeah, that's a good one, too, because I talked about all the benefits of after-tax, but I think with everything, there's upsides and downsides. And I guess I would say, you know, the downside of offering after-tax administrative burden. Now you've got an additional source that you need to track and remit payroll contributions for. That can kind of be cumbersome if you're a small or thinly staffed employer. And I guess I would say, I think I'm almost out of time, but I guess I would say also, just from a participant communication perspective, it's better with a more savvy workforce because Sometimes people get after-tax and Roth confused, and we don't want to see that happen. We want to make sure that we utilize it in situations where people are well equipped to understand the differences between the sources.
Great. Thank you, Kate, and thank you everyone who attended today's webinar. Any questions we did not get to, we will follow up with separately. As a reminder, please complete the survey questions that will pop up on your screen in just a minute. Everyone have a great rest of your day.